Welcome to the deep dive. Today we're tackling a question that's, well, become pretty central to the global tech conversation. Can the company at the very heart of the AI revolution, this multi-trillion-dollar colossus, truly sustain its astonishing dominance?
Especially when its own biggest customers are rapidly becoming its fiercest competitors, right? And you've got these swirling geopolitical storm clouds constantly threatening its supply chain.
Exactly. We're talking, of course, about NVIDIA. By the end of this deep dive, you'll have a clear understanding of whether its current share price of $167.02 as of September 5, 2025, offers a compelling opportunity or, maybe a perilous valuation.
Right. And our intrinsic value analysis, it gives us a range of about $155 to $195 per share. So we're going to unpack exactly what's driving that number today.
Okay, so our mission is to take your source material on NVIDIA Corporation, ticker symbol NVDA on the NASDAQ, and really distill the most important knowledge and insights.
Yeah, we'll navigate the complexities of its business, the management, financials, its market position, and crucially, the risks it faces, all to equip you with a truly well-informed perspective.
Okay, let's dive straight into Chapter 1, Business Analysis. Everyone knows NVIDIA as the undisputed king of the AI revolution, and rightly so. It's a $4 trillion company. It's just incredible.
It really is, but right off the bat, we have to highlight that that core tension we mentioned. Some of NVIDIA's largest customers are also becoming its biggest competitors.
And those geopolitical risks, they're not abstract. They're very, very real and, well, ever present.
Absolutely. And what's truly fascinating here, to understand NVIDIA, you can't just think of it as a chip maker. That's really not the full picture.
Right.
It's actually a full-stack accelerated computing platform company, which means they're integrating their powerful GPUs with proprietary software to deliver, complete solutions across diverse multi-billion-dollar markets.
So, historically known for gaming, but now revenue comes mainly from two segments: compute and networking, and graphics. And there's been this dramatic, almost unimaginable pivot.
Dramatic is putting it mildly. It's been a seismic shift. The compute and networking segment, which is overwhelmingly driven by their data center business, now accounts for nearly 90% of their total sales.
Wow, 90%.
Yeah. It just underscores their foundational role in the whole AI industry. To put some numbers on that, in fiscal year 23, compute and networking revenue surged by 41% to over $15 billion.
Okay.
While graphics revenue actually declined by 27% to around $9 billion. So a really stark contrast.
That shift is clearly reflected in their product lineup then.
Definitely. In compute and networking, their flagship products are the data center GPUs like the Hopper H100 and the next-gen Blackwell platform. These aren't just chips, they are the super processors, the engines powering AI training and inference globally.
And crucially, their high-speed networking solutions. That Mellanox acquisition seems key here.
Oh, absolutely essential. Things like InfiniBand and Ethernet switches are critical for linking, thousands of these GPUs into these massive data center scale supercomputers. And then there's the software. CUDA, their proprietary programming model. It is the absolute key, along with things like NVIDIA AI Enterprise and their Omniverse platform for digital twins.
So data center is the big driver, but what about their legacy in graphics? GeForce for gaming, Quadro RTX for pros, NVIDIA Drive for cars. How does that still fit in? It feels like a whole ecosystem.
It is an ecosystem, and while data center is the growth engine, graphics still contributes and reinforces the brand and the tech base. And when you look at their market position and sheer scale, it's just overwhelming.
Yeah, in 2025, they hit $4 trillion market cap. First company ever, most valuable public company globally.
And the numbers behind that dominance, they control over 80% of the market for GPUs used in AI training and deployment.
80%.
And in PC gaming. An astonishing 92% share of discrete desktop and laptop GPUs. Plus, their tech powers over 250 of the world's TOP 500 supercomputers. It's a remarkable lead.
So their primary value proposition isn't just selling powerful chips then. It's really about providing this comprehensive, integrated platform, solving complex problems, unmatched performance, developer productivity, that whole full-stack approach.
Exactly. And when we look at the industry, NVIDIA sits right at the epicenter of several powerful long-term growth trends. The global semiconductor market itself is robust, projected to hit almost $700 billion in 2025, maybe over $1 trillion by 2030.
And the AI chip market specifically.
That's where it gets really explosive. Forecasted to grow from maybe $52 billion in 2025 to over $164 billion by 2029. That's a compound annual growth rate of over 40%.
Wow. And Jensen Huang, NVIDIA's CEO, he has that staggering projection.
Yeah.
What was it? $3 to $4 trillion annual global spending on AI data center infrastructure by 2030.
Yeah, it's almost hard to fathom. A multi-trillion-dollar addressable market, basically building the infrastructure for the next industrial revolution.
But the competitive landscape is heating up. You've got AMD and Intel. They're formidable, sure, but they seem to lag behind NVIDIA in AI performance and especially that software ecosystem, right? CDA is the key.
Critically. And this brings us back to that core tension you mentioned earlier. What's really fascinating and maybe most concerning long-term is the hyperscaler competition.
Right, their biggest customers.
Mm.
Google with TPUs, Amazon with Trainium, Inferentia, Microsoft building their own stuff.
Exactly. They're investing billions to develop their own custom AI silicon. Their goal, reduce dependency on NVIDIA, lower those massive infrastructure costs.
And internationally, Huawei.
Yep, Huawei from China is aggressively developing its own AI accelerators too, driven largely by geopolitical goals for national self-sufficiency.
This co-opetition with the hyperscalers.
Yeah.
It feels like a high-stakes gamble. Is NVIDIA selling the picks and shovels knowing they're also funding their rivals' gold mines?
That's a great way to put it. And speaking of geopolitics, those U.S. export controls since October 2022, preventing advanced AI chips reaching China. That's huge.
Yeah, NVIDIA designed those lower performance H20 chips for China in response, but there's still so much uncertainty with China pushing for its own domestic tech. It impacts what NVIDIA sees as a potential, $50 billion AI opportunity.
Right. It's a major factor. Now, barriers to entry in this industry are immense. Tens of billions for fabs, huge tech expertise, relentless R&D.
But the biggest barrier seems to be that software moat, CUDA. Developed over 15 years, millions of developers, thousands of apps. The switching costs must be incredibly high.
Extremely high. It basically weaponizes dependency. It's not just the language, it's every major AI framework built on top of it. TensorFlow, PyTorch, they all run optimized on CUDA. It creates this technological inertia so profound that even those multi-billion-dollar hyperscalers find it cheaper to just pay NVIDIA, at least for now.
Okay, so that brings us neatly to NVIDIA's competitive advantages. Brand strength gaming icon to AI leader. Brand value jumped 98% to almost $88 billion in 2025, now a top 10 global brand.
And their cost advantages, economies of scale. That fabless model, outsourcing manufacturing to TSMC, avoids massive capital costs.
It gives them priority access too, right? And pricing power, especially for advanced packaging like CoWoS.
Absolutely. CoWoS, that cutting-edge technique for stacking chips close together for huge performance boost. TSMC prioritizes NVIDIA. And then those network effects and switching costs from CUDA, that's arguably their most durable moat.
It creates that virtuous cycle, doesn't it? More developers, more apps, more demand for NVIDIA GPUs, locking in frameworks like TensorFlow and PyTorch. Switching means rewriting years of work.
Precisely. And finally, their unique asset is that holistic, full-stack approach. Seamlessly integrating hardware GPUs, CPUs, networking with software like CUDA. It delivers unmatched performance and scalability. The system is truly greater than the sum of its parts. It's an ecosystem that's just incredibly hard to replicate.
Okay, now that we've mapped out NVIDIA's incredible business landscape, let's turn our attention to the people behind it in Chapter 2, Management Evaluation. One of NVIDIA's, greatest strengths seems to be the stability and vision of its leadership.
Definitely. Co-founder Jensen Huang has been CEO since 1993. That's an unparalleled level of long-term strategic focus in tech.
And his track record, navigating multiple crises. You mentioned near bankruptcy early on, the crypto mining bust, now the U.S.-China trade issues.
He's proven his ability to navigate incredibly tough situations. And his leadership style is interesting, too. Known for being direct, intellectually honest, encouraging people to confront challenges head-on.
Plus, robust investor relations, timely reports. And his personal reputation is stellar, right? HCR's best CEO times 100 most influential.
Yeah, that builds trust, attracts talent, and ensures a clear corporate vision. It's a significant asset.
Okay, that's a strong track record. What about capital allocation? How do they decide where to put all that money they're generating?
It's really all about reinforcing that technological leadership. They invest aggressively in R&D, almost $9 billion in fiscal 24. That's 18.5% of revenue, significantly above the industry average.
And M&A. The Mellanox deal seemed crucial.
Masterstroke. $6.9 billion in 2019, bringing high-performance networking in-house. It proved immediately accretive to margins.
And the failed ARM deal, even though it was blocked, that $40 billion attempt showed massive ambition, didn't it? Trying to control the entire computing stack.
Exactly. It highlighted their ambition. Since then, their M&A has shifted, maybe wisely, to smaller strategic tuck-in acquisitions, things like Run.ai and Deci, enhancing their software ecosystem and AI orchestration.
Makes sense. Now, returning capital to shareholders. They strongly prefer buybacks.
Overwhelmingly. First half of fiscal 26 alone, they returned $24.3 billion, mostly through buybacks. They authorized another $60 billion in August 2025. Annual buybacks grew from under $10 billion in FY23 to over $33 billion in FY25. It's massive.
But the dividend is tiny, $8.04 per share annually. What's that signal?
It signals belief in reinvesting heavily in the business for future growth and using buybacks to reduce the share count, which boosts earnings per share, EPS.
So it's a strategic statement for a hyper-growth company. They know triple-digit growth won't last forever.
Right. As growth eventually moderates, these buybacks can help bridge the gap, supporting EPS growth by reducing the number of outstanding shares. It's also a powerful statement of confidence from management that they still see their own shares as a compelling investment, even at these high valuations.
Smart long-term thinking. Okay, let's talk return on invested capital, ROIC. You said it's a key metric for efficiency, indicating a wonderful business. NVIDIA's normalized ROIC is, what was it, 98.19%?
Astonishing, isn't it? 98.19%. It means for every dollar NVIDIA invests back into its business, they generate nearly 98 cents in after-tax operating profit.
Wow.
It's just incredible efficiency and pricing power, and the trend is equally impressive, climbing from around 14% in fiscal 22 to almost 79% for the last 12 months of fiscal 25. Very few companies on Earth achieve that kind of return at this scale.
Okay, let's delve into Chapter 3, Financial Analysis. As of September 5th, 2025, market cap around $4.07 trillion. Still the world's most valuable public company.
And the revenue growth over the past 5 years. You called it exponential, and that's the right word. After strong initial growth, sales just hit an inflection point.
Yeah, more than doubled year over year for 2 straight fiscal years, reaching over $130 billion in fiscal 2025. Just staggering numbers.
And this explosive top-line growth translates directly into dramatically expanding profitability. It really shows their exceptional pricing power. Fiscal year 25 margins, gross margins 75.0%, operating margin 62.4%, net margin 55.9%.
Those are incredible margins for a company this size. Really shows how efficiently they convert sales into profit.
And the free cash flow, FCF generation?
Yeah.
Also astounding, surged from maybe $3.8 billion in fiscal 23 to over $60 billion in fiscal 25.
$60 billion.
Yeah, a torrent of cash. It's a direct result of that high-margin Fables business model and their market dominance. Gives them immense financial resources.
But what about earnings consistency?
Also notable, diluted EPS shows a pretty consistent upward trajectory. Trailing 12-month ETS was $3.51 as of July 2025. There was that brief plateau in FY23 due to the gaming crypto dip, but the overall trend is strong.
And financial stability? Balance sheet?
Fortress-like, minimal leverage. Their debt-to-equity ratio is just 0.08, incredibly low.
So for every dollar of shareholder equity, only 8 cents of debt. Minimal financial distress risk.
Exactly. And their current ratio is equally impressive at 4.21.
Which means, what does 4.21 tell us?
It means they have over $4 in current assets for every $1 in current liabilities. Exceptional liquidity, easily able to cover short-term obligations, reinforces that fortress balance sheet idea.
And the dividend, while symbolic at 0 over 4 cent share, it's been stable and shown modest growth recently.
Correct. Stable and growing slightly over the last 2 years.
Okay, valuation. Trailing PE ratio as of our analysis date was 48.21. How does that compare?
Well, compared to peers, IMD is similar at 46.90, Broadcom much higher at 111, Qualcomm way lower at 13.6, and Intel's currently negative. So 48 seems high, but
it's lower than NVIDIA's own recent peaks.
Exactly. It exceeded 65 back in 2023. This is what we call multiple compression. Earnings are rapidly catching up to that soaring valuation, making the current price relatively more palatable than it was, say, a year ago.
Now, for intrinsic valuation, we use a discounted cash flow, or DCF model. Briefly, that predicts future free cash flows and discounts them back to present value. accounting for time and risk.
And our educational DCF model suggests an intrinsic value range of $155 to $195 per share for NVIDIA.
Okay, $155 to $195, and what are the key assumptions driving that range?
Well, it's sensitive to assumptions, of course. For growth, we used a two-stage model. First, an aggressive but moderating 30% compound annual growth rate for the first 5 years, reflecting continued market leadership.
Okay, and after that?
Then a 4.0% terminal growth rate. That's our long-term assumption for how a mature company might grow indefinitely, slightly above expected long-term inflation.
And the discount rate?
We used 9.5%. That acknowledges their leadership and strong financials, but it also has to incorporate those significant risks we've been discussing.
Right. Let's shift gears then to Chapter 4. Market sentiment. How is Wall Street really feeling about NVIDIA right now?
Overwhelmingly bullish is the short answer. The consensus rating among 47 analysts is strong buy. 38 firms recommend it.
And price targets.
The average 12-month analyst price target is somewhere between $210 and $250. That suggests over 23% upside from the current price, but it's worth noting there's a wide dispersion in those targets, from $100 way up to $250.
So not everyone agrees on just how high it can go. What about the general media narrative? Still all positive.
Largely positive, yes. Focus on the AI boom, record results. But a cautious undertone has definitely started to creep in. More questions about growth sustainability, that sky-high valuation, supply chain issues, rising competition.
Yeah, I've seen recent reports noting the stock's been in a rut or extending its slide. Suggests a pause in that powerful momentum.
Exactly. Now, an interesting market indicator. Short interest. For NVIDIA, it's remarkably low, just 0.88% of the public float.
That is low. Peer average is over 5%. What does that tell us?
Well, the days to cover ratio is only about 1.1 days, meaning it would take just over a day for shorts to buy back shares. It signals very strong market conviction, maybe even potential complacency.
Complacency, how so?
Well, if the bullish story falters, there aren't many short sellers providing a counterbalance. It could lead to increased volatility if sentiment shifts quickly.
Okay, and technically, moving averages.
Yeah, looking at the charts, NVIDIA's stock is currently trading below its 50-day simple moving average of $174.05. That's generally seen as a bearish short-term signal, loss of recent momentum.
The 100-day.
Also trading below its 200-day SMA of $177.70. That's often interpreted as a more significant bearish long-term signal, suggesting the primary uptrend might be under pressure.
Okay, let's move into Chapter 5. Ownership structure.
Yeah.
Who actually owns NVIDIA, and what does that tell us about the stock?
Well, ownership is heavily dominated by large financial institutions. About 76.6% of outstanding shares are held institutionally.
Yeah, it's concentrated, right?
Very concentrated among the mega asset managers. Vanguard, BlackRock, Fidelity, State Street. Collectively, they own over 25% of the company.
What's the implication of that?
Well, this high institutional ownership, especially from passive index funds, creates a sort of stable demand floor for the stock. But it can also amplify momentum, both up and down, when these large institutions adjust their massive position.
Got it. What about insider holdings?
About 3.93% is owned by insiders, and that's largely dominated by Jensen Huang himself. His stake is around 3.77%, valued at over $150 billion.
Wow, $150 billion. That certainly aligns his incentives with shareholders. Does that level of personal investment, you think, influence strategic decisions?
Oh, absolutely. That massive personal stake suggests incredible long-term alignment. However, it's important to note recent insider transactions. They show consistent selling over the last 12 months.
Selling. How much?
Over 17 million shares sold versus only about 1.8 million purchased. Jensen Huang has been a regular seller through prearranged 10b5-1 plans. And there haven't been any open market purchases by key executive since back in December 2020.
Should we read into that selling?
You have to provide context. It's likely for personal diversification, estate planning, liquidity, standard stuff for someone with that much wealth tied up in one stock. It's probably not a bearish signal about the company's future prospects in itself.
Still, it's a lot of shares being sold. And you mentioned ownership concentration earlier. How significant is it beyond those top players?
It's pretty significant overall. The top 25 institutional shareholders own 46.43% of the company. As we said, the top 4 alone control over 25%.
So a relatively small number of large asset managers hold substantial influence over the stock price and potentially corporate governance. Something to watch.
Definitely something to keep an eye on.
Okay, now for Chapter 6, risk assessment. Let's try and bring it all together with a SWOT analysis. Recap the strengths first. Unparalleled market dominance, over 80% AI GPU share.
Incredible technological leadership, H100, Blackwell setting standards.
That formidable CUDA software moat we keep coming back to.
Visionary founder-led management in Jensen Huang.
And that fortress balance sheet. Low debt, enormous free cash flow. It's a powerful set of strengths.
It really is. But there are clear weaknesses, too. Extreme customer concentration, you mentioned. 2 unnamed customers were nearly 40% of revenue recently. That's high dependency risk.
Yeah, and the supply chain. Complex, vulnerable, heavy reliance on TSMC in Taiwan. Single point of failure, significant geopolitical risk right there.
And their premium pricing strategy. While it drives margins, it's also a potential weakness. Makes them vulnerable to lower-cost, good-enough alternatives, or crucially, those in-house chips from their own customer.
Right. Okay. Opportunities. Massive AI infrastructure growth seems like the big one. Multi-trillion-dollar global build-out.
Absolutely. NVIDIA is perfectly positioned there, plus expansion into new markets, autonomous vehicles, robotics, the Omniverse for industrial digital twins.
And that emerging sovereign AI trend. National governments building their own capabilities.
Yeah, that's a new, potentially huge, well-funded demand source.
Yeah, but these opportunities face substantial threats. The biggest long-term one seems to be competition from customers. Microsoft, Amazon, Google, developing custom chips.
That's arguably the most significant long-term threat, yes. Then there's the extreme geopolitical conflict, risk Taiwan manufacturing dependence again.
Can't overstate that one. And the semiconductor industry's history, those boom and bust cycles. A painful downturn is always possible if AI spending slows, right? Like the crypto mining bust.
Exactly. It's inherently cyclical, even with AI driving things now.
And what about broader macroeconomic factors? Inflation, interest rates.
Well, high interest rates increase capital costs, potentially dampening demand for big IT spending, including AI investments. NVIDIA's cash hoard provides insulation, but a broad slowdown could impact investment.
Inflation.
Could raise their costs, but their pricing power is so strong they might just be able to pass those costs on and protect margins. That's a key strength.
What about specific geopolitical factors? Those U.S. tariffs from 2025 on imported semiconductors.
Aimed at boosting domestic manufacturing. Could cause short-term disruption, maybe, but paradoxically might strengthen NVIDIA long-term if it incentivizes a more resilient U.S. supply chain.
Interesting take. But the ongoing U.S. export controls to China, that remains a major headwind.
Absolutely. Cuts off a massive market, forces R&D diversion to less capable chips. It creates a volatile and uncertain operating environment for that part of their business.
Okay, let's bring it all together. Chapter 7. Conclusion. The bull case for NVIDIA. It's incredibly powerful, isn't it? Generational tech leader, near monopoly in AI hardware, visionary founder.
Staggering financial performance, triple-digit growth, expanding margins, fortress balance sheet.
Protected by that deep, durable CDA software moat.
And addressing a trillion-dollar market for AI infrastructure that's really just getting started. It's a compelling story.
But the bear case. It argues that while NVIDIA is a phenomenal company, maybe it's trading at a perilous valuation, pricing in, what, a decade of flawless execution?
That's the argument. And acknowledging the substantial risks, extreme customer concentration, customers becoming competitors with in-house chips.
A precarious reliance on TSMC in Taiwan.
And the semiconductor industry's historical boom and bust cycles. You can't ignore those.
So restating our valuation summary, our educational DCF analysis suggested an intrinsic value range for NVIDIA of $155 to $195 per share.
Right. And our concluding outlook is, well, neutral based on that. NVIDIA's current share price of $167.02 falls within our estimated intrinsic value range.
Okay, so fairly valued according to our assumptions, but maybe not offering a significant margin of safety.
Exactly. The market seems to be pricing in its dominance and growth, but also implicitly accepting those substantial risks we've laid out.
So what does this mean for you, the listener? Well, you have to weigh that powerful bull case against these considerable, very real risks. You need to determine if the current price offers a truly compelling opportunity for your own portfolio and risk tolerance.
And here's a final provocative thought for you to consider as we wrap up. As nations worldwide increasingly prioritize sovereign AI, beating their own national AI capabilities, how might that trend fundamentally alter global demand for NVIDIA's high-end products?
Could it reshape the competitive landscape? Maybe create new geopolitical vulnerabilities for NVIDIA? Or perhaps open up entirely new segments of demand in ways we haven't fully imagined yet. Something to think about.
Definitely food for thought.
We hope this deep dive into NVIDIA has given you a clearer understanding of its powerful position and the complex forces at play. If you're looking for more expert analysis like this, please remember to like and subscribe to the Stock Analytics AI YouTube channel.
Yeah, and our 4.99-month members get priority deep dives on tickers. Over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those.
And if you want a one-off deep dive on a specific ticker that maybe isn't on the immediate list, just drop us a super thanks on YouTube.